beating Warren Buffett, Peter Lynch, Ray Dalio, Steve Cohen, and more. This is the man who sold the market and his strategies. He's generated over $100 billion in earned profits. His name is Jim Simons, but he's often referred to as the Quant King, but little is known about his strategies. Here's everything I could find out by researching him and reading a great book on him back to front. Now, if you want to check out the book for yourself, it's called The Man Who Sold the Market: How Jim Simons Launched the Quant Revolution. After spending hours researching and reading back to front one of the best books about him by Gregory Zuckerman, I might be saying that last name correctly, my apologies if I'm not, I found out 6 key things you can learn from his trading and implement it into your own. First is beyond logic. Simon came to the conclusion that markets often defied traditional logic, but he did see some structures recurring in the market. He began extensive data mining to find predictive signals, focusing on predicting price action based on events rather than pure price action. This is a really small nuance, but I think it's actually a really good point. A lot of the time through his interviews and also through the book, he mentions only predicting price action based on events, which means this could be like a economic release, or CPI data came out, or some event or some news, or maybe an asset broke all-time highs or something like that, just based on an event-based system that then he started to predict the probabilities of what was likely to happen next, instead of just basing predictions on pure price action. So let's say, the tape, or, double top highs or things like that. And this is a really small nuanced addition, but I think it's something that can be really useful, especially when you want to build your own strategies, especially if you're looking into the quant space. Try and focus on building probabilistic strategies based on events rather than just pure price action. This means uncorrelated predictive signals is the key. If the Quant King himself is unable to find a golden strategy, I think the answers to the question on if you need one holy grail strategy or portfolio strategies is answered. Now, the risk of correlation is when your strategies move together. If one strategy loses, the other is likely to lose at the same time. This is no good, especially if you're trying to trade and deal with drawdowns. You want your strategies to be as independent as possible. For example, if all your strategies are on the same time frame, using similar parameters and on the same instrument or asset class, this equals it to be very correlated. This high correlation means you're not very diversified. Now, I know, especially when I first came into trading, diversification sounds like a term that's only applied to people that are doing long-term investing, but it actually really applies to quant trading, or even just, I guess discretionary trading to some sense, if you'd like to manage multiple strategies and have multiple strategies. You really don't want to be correlated all in one instrument, or, as I was mentioning, one asset class with the same kind of parameter, same time frame. Instead, often common ways you can do this is by trading different instruments. So maybe your current strategies are on NQ, for example, or S&P 500. You could trade crude oil or another different asset that isn't directly linked to the indexes. However, trading on different indexes and on different time frames and different parameters, there is a case there to be made that they are uncorrelated. There isn't really a signal that tells you, hey, this is perfect if it's uncorrelated or not. There are a couple formulas you can use online, but even then, there really is no pure, certain answer that they aren't correlated. Also, another thing to think about is correlations move over time, meaning, maybe in 2018, these actually weren't correlated, but nowadays they actually are. An easy example of this, at least from my knowledge, is like BTC, so Bitcoin and like SPY. They actually have become a bit more correlated over time. So this is just something to be wary of, especially when you're having strategies, and making sure to always measure your correlation over time, and also just apply, I guess, some common sense and also your own experience to see if things are maybe becoming more correlated. Next is his strategies. So first, he mentions a trend strategy. So this utilizes advanced mathematical models to capitalize on market momentum. This is also kernel aggression approaches. So you can check those out if you'd like to go more into the math side of things. There's a couple of articles about them. Now, I will say none of his strategies are fully revealed, obviously, online. However, he pieced together through different research and different, mainly through his book and different podcasts and interviews, you can get some idea of what he's kind of doing. Next is the mean reversion, so capturing predictable swings by buying undervalued assets or selling overpriced ones. This was mainly based on historical events. So I think the example he gave was, let's say if this was the lowest it's ever opened, percentage-wise or whatever he was measuring it by, then it would be a mean reversion to the upside as you'd be buying it, and the other way if it was the opposite. And then this could be applied to different timeframes, to be applied not just to the open, and there's multiple things you could kind of look into on this. Next is seasonality. So this was leveraging cyclical patterns to predict short-term movements. So this was, I believe the classic example for this was that there was a higher likelihood of it opening positive on Monday when it closed a certain percentage red on Friday. I might be mistaken about that one, but you can still look it up for yourself. I think he mentions it in one of his podcasts, or I guess interviews, sorry. So you can look into that a bit more, but there are still some strategies that can be just based pure of seasonality and basically time. So this is another great area for you to explore if you want to explore a different type of strategy, especially if you want to create uncorrelated strategies. But one of the most interesting was the HMM model. This was the hidden Markov model, and this was a probabilistic model for predicting stock movement. It focused on inferred market states rather than fundamental economic stats, identifying macroscopic variables using mathematics. Now, obviously, this strategy, there really isn't much known around it overall, except this kind of definition. However, you can look into it more. I think people have pieced together small pieces of it, or at least, try different attempts of what it could potentially be. Obviously, here is a big kind of disclaimer. I wouldn't recommend necessarily just trying to find online Jim Simons strategies and trying to reproduce them. I think the thing that people often miss with Jim Simons is, yes, he has some of the smartest people working for him. He is also one of the smartest men alive. But he has uncovered a lot of good principles that you can use and apply in your own trading, even if you are not going to build, the next kind of medallion fund. And one of these kind of things I'm going through the videos is the idea that you want multiple different types of strategies. You want that uncorrelatedness between those strategies, and these are some of the kind of key points around it. Now, Jim and his team also really carefully consider the costs of their strategies. This includes classics like commissions and slippage, but also the strategy size to see how it impact price movement. This is normally called the impact theory, and what this basically states is at a certain size on a particular strategy, once you actually enter the market, you'll probably move the market, causing more slippage and affecting profitability. Now, obviously, this won't apply to most people, but sometimes when you're dealing with really illiquid strategies, you will need to have some knowledge of this impact theory or be able to apply it to your backtests. And actually even measure it in your forward tests to see how that's going to impact that strategy's profitability, as sometimes it can be great. And I've seen this cause issues for people that are trading very liquid crypto stocks, crypto coins, I guess you'd call them. And this is sometimes a really big issue. So make sure you be careful of this one. Another key thing I would just mention here was Jim Simons and the Medallion Fund overall were really ahead of their time on data cleaning and good infrastructure, which just states why it's really important to me making sure to using good APIs, which allow you to do good data analysis and then also create subsequent good strategies. If you have poor data, the results will always be poor. So make sure you're taking your data cleaning and your data very importantly. Otherwise, this may break down your whole trading or your quant trading. This will only cause unprofitable strategies when you're actually taking them live. Lastly, this is constant research. Simon understands that predictive signals decay over time. Constant research and development alongside with collaboration with fellow quants and traders was vital to their enduring success. Staying curious is vital, and shows why idea generation is also key. Now, you want obviously a good backtesting process, you want a good data cleaning process, you want a good forward testing process, and obviously you want some good common sense around overfitting and potential and robustness testing. However, this all starts from idea generation. If you do not have a continuous stream of ideas you can start to test and be curious about, you are always going to come into a issue where one of your strategies stops working, and then you're having to spend a lot of time researching to find that kind of new strategy. This is why personally, even though right now I haven't switched out any of my strategies trading futures, I'm still researching new strategies every single day, and I'm still looking into different methods or different parameters or whatever, just to keep my mind curious and also somewhat in tune with the market, which can be really important. Now, while Simon's exact methods remain shrouded in secrecy, his philosophies offer invaluable lessons to us. He teaches us to look beyond the surface, embrace data-driven analysis, diversify our strategies, and constantly evolve, which I think some people missed with some of the videos I shared that went semi-viral on Twitter, where he didn't just give us the game plan of, hey, guys, just do this and you'll make $1 million or something like that, but he really did allow us to see an insight into one of the most successful funds and some of the principles they stand by, which is also very valuable. Thank you for watching, and if you enjoyed, please like and share it with anyone else who might be interested, and I'll be sure to do more videos on Jim Simons or these kind of related topics if you guys are interested.